Hello dear students, welcome to another video lesson on Principles of Insurance. This is Dr. K.G. Mallikarjuna, Associate Professor of Economics, Government College for Men, Kurnool. Under the topic, we are going to observe various principles of insurance. Whenever the contract takes place between insurer and the insured, these principles plays very crucial role. They are the principle of indemnity, the principle of good faith, doctrine of subrogation or principle of subrogation, principle of cause proxima, principle of insurable interest, principle of contribution, and lastly the principle of loss mitigation. So let us start with the first principle, that is principle of indemnity. This principle imposes that only damage will be insured. That is, beyond the damage you cannot get any benefit. The only damage is to be insured. That means insurance cover only the sum insured by the policy holder. The policy holder will not be eligible to benefit from his entire loss. Insured cannot make any profit from the insurance contract. Insurance contract is meant for coverage of losses only. So the point here to remember is indemnity means a guarantee to put the insured in the position as he was before the accident. Let us see the second important principle of insurance, that is the principle of utmost good faith. According to this principle, the contract between insured and insurer must be in a utmost good faith conditions or good faith environment. The insurer and the insured must give each other the correct and complete information. That is, the exchange of information between insurer and insured must be with good faith. The contract is not valid or the contract will be void when the information given either of them is false. Insured should provide all the information regarding the policy, that is, what type of benefits he is offering and how much will be the premium, etc. information should be given by the insured. Likewise, the insurer should provide all the details like his age, family members, health conditions, habits, etc. correctly to the insurer. Let us take one example. Ram was a smoker and he didn't disclose this fact. After getting the policy, he got cancer. Insurance company is not going to pay anything to the Ram as he didn't reveal the important facts to the insurer. The doctrine of subrogation or the principle of subrogation. According to this principle, the insurance company is empowered to collect the sum assured or the loss incurred from the third party who is actually responsible for the loss or event through his negligence. This principle prevents the insurer from collecting the same loss from both the insurance company and the third party. Let us try to understand this situation with an example. When a scooter is assured with insurance and subject to accident with a truck, then the entire sum will be recovered by the insurance company from the truck owner and will be paid to the scooter owner. This principle also implies that after the insured gets the claim money, the insurer will take the damaged item into his custody. After making the payment of insurance claim, the insurer becomes the owner of the subject matter. For example, Shiva took an insurance policy for his car, and in an accident his car totally damaged. Insurer paid the full policy value to the insured. Now Shiva can't sell the scrap remained after the incident. Principle of cause proxima. Here the word cause proxima means nearest cause only. An accident may be caused by more than one cause. In case property insured for only one cause, in such case nearest cause of the accident is found out. Insurer pays the claim money only if the nearest cause is insured. For example, a ship carrying orange was insured against losses arising from accident. The ship reached the port safely and there was a delay in unloading the oranges from the ship. As a result, the oranges got spoiled. The insurer did not pay any compensation for the loss because the proximate cause of loss was delay in unloading and not any accident during voyage. The principle of insurable interest. The principle of insurable interest states that the person getting insured must have some insurable interest in the object of insurance. A person has an insurable interest when the physical existence of the insured object gives him some gain, but its non-existence will give him a loss. In other words, we can say the insured person must suffer from financial loss by the damage of the insured object. For example, the owner of a taxi cab has insurable interest in the taxi cab because he is getting income out of it. But if he sells it, he will not have an insurable interest left in that taxi cab. The another example is if husband dies, loss has to be paid by wife. But here psychological attachment do not allow to be insured, like a friend or some other relative, etc. Some blood relationship must be there between the policy holder and the insured. Here we can see some examples. Only legally recognized relation will be allowed to accept the policy, like husband and wife, father and son, mother and daughter, like that. Even insurable interest can also seen between the employer and the employee. Insurable interest also vested between the creditor and the debtor. Insurance on own car, insurance for own house, these also having some insurable interest. Sixth one is principle of contribution. It implies when more than one policy is taken on the same object matter. One thing you have to remember that compensation only to the extent of actual loss will be provided. You cannot get more than the actual loss. And here the compensation can be collected either from all insurers or from any one insurer. The option is left to the owner, but the total compensation received by the insured must be equal to the actual loss only. If the compensation is totally paid by one insurer, then he will collect the remaining benefits from other companies, other insurers proportionately. It avoids collecting compensation multiple times the actual from the multiple companies. For example, if Mahesh assured 3 lakhs from insurer A and 1 lakh insurance from insurer B, then he can claim total 3 lakhs of rupees from insurer A alone or 2 lakhs from A and 1 lakh from B. In case he claimed 3 lakhs from A only, then company A will claim 1 lakh insurance from company B. Now the last principle, seventh one, the principle of loss minimization, otherwise the principle of mitigation. This principle says that during the mishap, the insured must take all possible steps that he can take to reduce or mitigate the loss. Insured does not become negligent about the safety being insured. The insured is expected to act just as a matter has not been insured. If the item is not insured, and what will be the reaction of the insurer towards the mishap must be the same as if he take the insurance policy. For example, during fire accident of insured property, the insurer must act to reduce loss by calling nearby people for help, and through the water available within the area, calling fire engines and some other steps. So thank you very much for paying your attention. If you like this video, please thumbs up or subscribe to my channel for more videos. Thank you very much.